Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It's May 16th. We're halfway over through May. And boy, oh boy, if summer's not here, it sure as heck feels like it because the weather's been really, really warm. I think it's going to be close to 90 today. It's about 7:40 in the morning. The market's going to open up in about an hour and 50 minutes, give or take. And I'm expecting a lot more volatility this week. There's a couple of things you need to know about that are on the docket. Now, looking here, the Nasdaq is down about 60 points. The Dow's down about 48. Not really anything significant when you consider that the volatility on the Dow has been reaching about 700 points per day. So the fact that it's down 51 points pre-open is not really here nor there, or the fact that the S&P is down 58 points because the volatility, as I said, has been just off the charts. In terms of what we've got going on this week, we've got retail sales and industrial production. Those are going to be the big reports. Then Mr. Jerome, I can't predict the future. Oh, wait till I can. Powell speaks at 2 o'clock. That's going to be very interesting. Then you've got housing starts and permits. Don't think that's going to make a big deal. But then you've got the manufacturing index. I think those are going to be the big reports. The retail sales, industrial production, and Philadelphia Manufacturing Index. The retail sales is going to give us consumer sentiment. Consumers make up 2/3 of the economy. Now, buying or spending has been very strong. Businesses and consumers. I want to see if that's going to continue. The expectations, retail sales minus vehicles. Let's not bring vehicles into this, or vehicles and gas practically. It's -2 to 0.9. Now, when you look at it with everything as a whole, they're looking at 0.9. We'll see if the number is better than that. It can really cause a good rally because we need consumers to step up right now. It would show that consumer confidence is really strong. That reflects on the GDP. If the number is really weak, then it's going to give the Fed a higher impression that this country is going to fall into a recession. And if the country falls into a recession, they may start backing off rate hikes. So again, it's a balancing test right now. It's how fast and how reactive the Fed will be in light of how fast the economy is growing. So it's just a balancing act to try not to push us into a recession, which I think they can do if we start seeing, if the war goes away and if this COVID doesn't come back to us. And again, the next report is the Philadelphia Manufacturing Index, and we'll talk about that as the week progresses. But again, the industrial production is going to be big, retail sales is going to be big, and the manufacturing numbers are going to be big. I don't think the housing starts or the existing home sales is going to be a huge factor because markets are already anticipating a slowdown due to the fact that interest rates have been going higher. Remember, bonds and interest rate have an inverse relationship. And this is telling us bonds have been going higher. But the thing is, look at when interest rates started going higher, all the way back December of last year. That means most of the action is priced in. And the question is, if the bonds become choppy now or start heading higher, which is a possibility because we've been kind of losing the vertical angle and kind of getting a little more choppier. If that begins to happen, that's a good sign that the long bond doesn't anticipate that the interest rates are going to get higher, and it means that we may have a little reprieve because lower bonds, higher rates, bad for stocks. Choppy bonds or higher bonds, relief for the stock market. Again, I'm going to repeat that in case you're new to this. Lower bonds means higher interest rates. Higher interest rates are bad for the market. Once bonds start moving sideways or going up, that means interest rates are no longer in the long bond. The long bond is no longer at a threat in the near term of going higher, which means that decreases the pressure on the stock market, okay? So the more this goes choppy and higher, the better it is for the stock market, if that makes any sense to you. Now let's talk a little bit about global economy, and then we'll get into the nitty-gritty. Investors are eyeing surging energy costs and prospects of interest rate hikes in the U.S. That's been on the table now for a few weeks. And there's more talk about the war, which seems to be shifting from how long it's going to last to Putin is not well, and there may be a coup, which is it could possibly be true, but it's showing that there is some hope for this thing to end sooner than later. And the market, there's no way the market will not assimilate that narrative, okay? Some analysts worry that if the Federal Reserve raises interest rates too quickly or too much, that could set off our recession. That's exactly what I was just saying. A slowdown in the U.S. would almost certainly hurt Asian region, which exports and manufactures goods for the U.S. economy, and their export has been crap lately, which is really bad for us. The Fed has said it'll continue to raise interest rates to temper rising inflation. The benchmark short-term rate was at a record low of near zero during much of the COVID pandemic, and boy, oh boy, they're sure as heck making up for it right now. Bank of Japan reports that wholesale inflation rose 10% in April. Ouch. From a previous year. Can you imagine? 10%. The highest since 1881. Oh boy. Japan's consumer prices have not risen at such a brisk pace in recent months. April consumer prices are due out later this week, so we'll see if it's still continuing. Back in the U.S., U.S. retailers are reporting this week, including Walmart, Target, and Home Depot. This is going to be very, very significant because this will give us a good pulse on how consumers are spending money. If people are spending money at Walmart, Target, or Home Depot, that's very, very significant right now. Very, very significant. And more importantly than how these stores are doing in the last quarter, I want to hear forward-looking projections. Markets have been slumped since October. It says March, but they've been slumped since October of last year, as traders worry that the Fed may not succeed in its delicate mission of slowing the economy, to rein inflation in a forward decade without causing a recession. Yeah, it's true. The Fed should have caused interest rates to go higher quicker, but they did not, and that's not helping us right now. Now, as far as sectors, and I've been talking about this to anyone who's been listening, if you look at the indices, let me just show you the heat map. The heat map is showing, look at Friday, consumer discretionary and technology were leading, all right? Energy was the third spot, and communication services is no longer here. Well, maybe it's a coincidence. Let's go back 5 days. Communication staples and communication services, the sector that's been lagging the most over the last, since January 7th. It's now going higher. It's not my imagination. This is the third time I'm bringing this up. And energy's coming down. Now let's look at it on a 30-day basis. Well, energy's still leading, consumer staples is following, but communication services is now above consumer discretionary. Folks, that's the first time in a long time we're seeing this. And if you're looking at my sectors, my cumulative strength index, if you look at it over here, you will see that communication services is still lagging. It's still 18.44% versus 17.6. But on a cumulative, on a monthly, it's no longer there. And real estate is down only 0.15%, 0.15%. So this is going to switch over. My point is, I told you this is happening, and it looks like it is happening. There's a good scenario for consumer staples to take over the first spot on energy, and communication to start moving higher. If communication starts moving higher, you've got Netflix, you've got Google, and another major large cap FANG stock in there, Facebook in there. So you've got three FANG stocks in there, and this rally is starting to come up. Looking at it on a chart, energy looks like it's going to make new highs again. Consumer staples looks really strong here. Utilities looks really good here. Industrial looks like it's due for a bounce. Financial looks like it's due for a bounce. Technology looks like it's due for a bounce. But notice this outlier here, that little swing down. Healthcare looks like it's due for a bounce. Basic material looks pretty good here. Consumer discretionary looks good here. Communication services looks good. Everything looks overdone right now. Now, does that mean the market's going to go bullish? No, it means that we're going to have a bounce. And we will see what the Fed says. We will see what the data says. But the market is grossly overdone. Look at the number of stocks in the NASDAQ 100 trading above the 50-day moving average. 13 stocks. Look at 2020. We had 11, and during 2008, we had 10. Now look at the S&P 500. We're almost there. Another 10%. We're going to be at 2020 levels, and look at 2008. So, folks, from where I'm sitting, we don't have much, if anything else, to go. Also, volatility started selling off last week. we're no longer at the 35. We're now at the 28 level, and I'm expecting this to come down all the way to 20. Here's another major factor that the market's moving higher right now. If you look at the Dow Jones, this is a little clue for you. This should help. If you look at, notice the ATR, average true range, set it on 10. And if you put it here, you will see that this is volatility. This is, let me just make this small so you could see what I'm talking about. Oops, excuse me. Settings, there we go. There you go. So as you can see here, look at the volatility and look at how this peaks out. And if you look at it over long term, just so you could see the levels here, we haven't been at this levels since, let's see here, since COVID, right around COVID time. I mean, it's been a while. Oh, since 2020, since earlier this year. But let's see. Let me go a little further back here. Yeah, look at that. COVID. The only time we went above these levels was COVID. So as you could see here, volatility is starting to come off, and that means higher prices. I think we should at least go to the 50-day moving average, but I'm expecting a rally. Everything looks overdone. So be careful, a lot of volatility, but markets are in fact looking bullish. Now, before I let you go, I've got something important for you. Joy of the Trade, Jeff Zananeri, he's back in the saddle, and he's going live at 1 p.m. Eastern time today. He's going to share a market phenomena traders won't hear about anywhere else. In fact, no one is talking about this, and I love when Jeff talks about things that no one's talking about. Like he was talking about China 2 years ago, like he was talking about all the things that are happening right now a couple of years ago. Kathy Woods, he was on that like 2.5 years ago. No one's talking about this stuff. The media would rather recommend stocks that have already soared before getting crushed in these cutthroat markets. Today, Jeff wants to share a few tricks that are, and a few tickers on stocks that are tanking. You guys got to check this out because they're primed for 16-hour snapbacks. That's right, 16-hour snapbacks. I love that. No day trading, but overnight, get in at the end of the day, get out next morning. Click on the link below to learn about Jeff's trading phenomena and how to access today's free event. Do it right now. Tomorrow, strongest sector, strongest stock, weakest sector, weakest stock. Do not miss out. Follow the link below. Send me some love letters at support@marketgeeks.com. And if you can't find the link, you go to the YouTube Wealth Press channel. It's in the descriptor. Have a great week. It may be a bullish one. Bye.